I would say that as structured, there's really no other way other than to continue monetizing it, and that's the problem. So, for example, the Fed is interesting in the sense that when things get really extreme, they lose control. So, for example, the 1940s during the war era, they were just overtaken by the Treasury. They were forced to monetize the deficits and to keep them at low interest rates. And in the past couple of years, when we had these extreme events in various ways, they just jumped in and monetized it right away. And so they can try to be independent when things are going reasonably well, but as soon as you have a problem in the sovereign bond market or one of those adjacent markets, they always jump in. And so one thing that's interesting is that during COVID, Powell asked for more fiscal support. He said, "Look, our tools are kind of exhausted. We need more fiscal." But you don't really see the opposite happening now. You don't see him coming out and saying, "Look, we're trying to tighten, but these very large fiscal deficits are outside of our control. And if you want to more sustainably get inflation under control, you'd have to reduce those deficits. That's a fiscal decision, and you don't really see him doing that. And so I think one thing the Fed could do is say, look, I mean, our tools are mostly designed to affect the rate of bank lending. So we have tools that can kind of incentivize or promote the rate of bank lending, which is generally pro growth or pro inflation. We can slow down the rate of bank lending, which helps reduce inflation or help kind of slow things down. But if you're running very, very large deficits, that's going around our tools. And that's largely outside of our purview. And that's mostly a fiscal problem. So a lot of my emphasis is pointing out that, in some ways, regardless of what the Fed does, it's largely a long-term fiscal spiral that we're going through.
In this insightful analysis by Lyn Alden, she discusses the potential for a bond crisis in the US economy. Highlighting historical data, she draws parallels between the instability of the Bretton Woods era and the current fiscal landscape. Alden emphasizes the challenges posed by large, sustained deficits, pointing out that the Fed's tools designed for bank lending control may be insufficient. Lyn Alden delves into the intricacies of the fiscal spiral, where attempts to curb inflation through rate hikes exacerbate deficits, creating a concerning feedback loop. Alden suggests that addressing long-term fiscal issues, including unsustainable programs like Social Security and Medicare, is essential. Don't miss out on this critical analysis. Like, share, subscribe, and hit the notification bell for more financial insights.
Over the past century, the biggest comparison was, say, gold and the dollar, whereas gold obviously held its value a lot better than the dollar, but the dollar had various advantages of speed and convenience. And so even though the dollar was weaker, it was still stable enough that especially when you combine, legal monopolies and legal tender laws, things like that, that the dollar was able to win out. One thing that's interesting about Bitcoin is that it's over the long term, it grows even less than gold in terms of new supply, so it's even scarcer than gold, and it can move around as fast or faster than fiat currencies can. And so that's a really compelling long-term story to get people to gravitate towards it and change some of the structure. Although, in my view, that's a multi-decade story. That's not like a 1 decade or a 2 decade story. It takes very long time to change these gigantic structures. And one thing that's notable about the Bretton Woods era is that a lot of focus is on that 1971 decision to leave it, but what the evidence shows is that it was breaking basically throughout the 60s. The Bretton Woods system, it was decided upon in 1944, it was implemented in 1946, but then it wasn't really even fully implemented until the late 1950s. That's when they undid some of the kind of the post-war era controls that were in place, and that's when they actually started that overall process. And from that point, the amount of gold reserves went straight down. And that's partially because we were running significant deficits. And it's also partially because banks, fractional reserve banks, were lending more dollars into existence, and they were not constrained by the amount of gold in the system. So you had an environment where, from 1950 to 1970, the broad money supply tripled as gold reserves diminished. And so the system was inherently unstable to begin with. It was always a rational decision to redeem some of those ever inflating dollars for gold until they were going to run out of gold. And so we kind of have this story where we centralize everything, and then over a matter of decades, that centralized entity fails. Partially because it was just unstably designed to begin with. It was kind of, it was like great while it lasted, but it was designed not to last, is the
Right.
challenge. Example, if you look at the history of the dollar, it was defined in 1792. And from there all the way up until the early 1900s, its purchasing power remained unchanged. It could buy the same amount of gold. It could buy the same amount of general goods and services based on most estimates. During wars, there'd be some period of inflation, but then it would kind of revert back after the war. And it wasn't until this more modern era where we began centralizing everything and growing the money supply on average at a faster rate that we started to get this devaluation. And to your point about who it affects or who it helps most, basically it's kind of the economy is kind of like a game of blackjack, where with blackjack you want to get close to 21, but you don't want to go over. And the way that who best is rewarded in this economy is people that have debt, but not so much that they blow up in a recession. So if you have long-term low interest rate debt and you're using it to buy scarcer assets, real estate, business, cash flow, business equity, things like that, the closer you are to the source of money creation, you're shorting the fiat currency that everybody else is earning their wages in and saving their near-term money in, and you're buying scarcer assets, and you're doing very good, especially because you have global arbitrage. You can short one currency and buy assets somewhere else, for example. Whereas if you're on the other side of the spectrum and you don't have a lot of access to credit and you're just kind of earning wages, you're saving a little bit, you're getting constantly devalued. You're getting paid in melting ice cubes. And so that's kind of the divergence we've seen over the past several decades, which is that it's very kind of challenging. And in the United States, we've had it still pretty good. For example, I spend part of each year in Egypt, and they have 20% annual money supply growth. And so you can imagine everything is dialed up. Everything is, the prices are on average going up a lot quicker. Even banking access is lower. So fewer people have access to banks to even earn interest to partially offset the devaluation that's occurring. So if you're on the bottom of the income spectrum there, you're literally dealing with cash. You're getting paid in cash, whatever small savings you have are in cash, and that's literally inflating away at 20% a year on average, year after year after year after year. While if you're fairly wealthy, you might be shorting the currency. You might be, buying real estate with a multi-year loan at pretty low interest rates, or you might be doing some sort of arbitrage, for example, where you're actually benefiting from that devaluation of that currency. And that's happening in 160 different currencies around the world to different speeds and different levels and different opportunities. And I think that basically we spent the last several decades financializing the economy, and I think that some of these technologies allow us to shift that pendulum back a little bit towards, in some ways, less financialization and more real world building, and kind of sending the incentives back towards those who earn and save. I would say that as structured, there's really no other way other than to continue monetizing it, and that's the problem. So, for example, the Fed is interesting in the sense that when things get really extreme, they lose control. So, for example, the 1940s during the war era, they were just overtaken by the Treasury. They were forced to monetize the deficits and to keep them at low interest rates. And in the past couple of years, when we had these extreme events in various ways, they just jumped in and monetized it right away. And so they can try to be independent when things are going reasonably well, but as soon as you have a problem in the sovereign bond market or one of those adjacent markets, they always jump in. And so one thing that's interesting is that during COVID, Powell asked for more fiscal support. He said, "Look, our tools are kind of exhausted. We need more fiscal." But you don't really see the opposite happening now. You don't see him coming out and saying, "Look, we're trying to tighten, but these very large fiscal deficits are outside of our control. And if you want to more sustainably get inflation under control, you'd have to reduce those deficits. That's a fiscal decision." And you don't really see him doing that. And so I think one thing the Fed could do is say, "Look, I mean, our tools are mostly designed to affect the rate of bank lending. So we have tools that can kind of incentivize or promote the rate of bank lending, which is generally pro growth or pro inflation. We can slow down the rate of bank lending, which helps reduce inflation or help kind of slow things down. But if you're running very, very large deficits, that's going around our tools. And that's largely outside of our purview. And that's mostly a fiscal problem. So a lot of my emphasis is pointing out that in some ways, regardless of what the Fed does, it's largely a long-term fiscal spiral that we're going through. And even if you look at the Congressional Budget Office's long-term projections, it's just larger and larger deficits as far as the eye can see. And then you get that negative feedback loop where if the Fed actually tries to raise rates to slow down inflation, they exacerbate the deficit because there's so much debt relative to the size of the economy, and therefore the interest expense
Right.
goes up,
In the spiral.
and then they issue more debt to pay the interest. And so it's largely the source of the concern now, I would say, is emanating from the fiscal side. Yeah, I think the challenge there is that the fixes are would be so unpopular that those trying to fix it would be voted out. and then they go back to
Right.
not fixing it. So, for example, the demographics are such that things like Social Security and Medicare are not long-term sustainable as designed. They were designed in a different era. They weren't designed with the idea that population growth would eventually slow down and that the society would become very aged. So if you look at, for example, how many workers pay into Social Security for every retiree, that number keeps shrinking over time, where it becomes a very big burden for the small number of workers paying in. And retirement age, was originally around the average human life expectancy. So some people didn't even make it to there. Some people went over, but in general, there weren't people kind of living on those benefits for many decades. Whereas in recent decades, our life expectancy has gone up quite a bit, but our retirement age has gone up at a slower pace. And so there's that ratio of longer periods of receiving support. And so you have this thing where it's just economically unsustainable. Also, I mean, the way that we structure our healthcare system and kind of the health problems we have, related to diet and things like that, have kind of blown out the deficit on the Medicare side as well, arguably as big or bigger as Social Security. And so, without kind of fixing the overall long-term balance of those, it's very hard to get the deficit under control. But anyone trying to touch those, one of the few bipartisan things out there these days is don't meaningfully touch those, because politicians are working on their incentives, and if you try to meaningfully cut those, you basically lose the election, and then the next person doesn't cut those.
Exactly.
And the same
Yeah,
thing
no,
for military, basically, foreign adventurism.
Thank you for joining us today as we explored the fascinating insights into the past century's monetary systems and the potential impact of Bitcoin on the future. From the comparison of gold and the dollar to the intricate dynamics of the Bretton Woods era, we've delved into the complexities that shape our financial landscape. As we reflect on the multi-decade story of change and the challenges posed by the current fiscal environment, it becomes evident that the interplay between centralization, inflation, and the growing money supply has profound implications. Whether you're intrigued by the historical perspective on the dollar's purchasing power or considering the long-term consequences of fiscal policies, the dialogue has been both enlightening and thought-provoking. We encourage you to share your thoughts in the comments section below. What are your views on the current monetary landscape, and how do you perceive the role of emerging technologies like Bitcoin in shaping our economic future? Don't forget to subscribe, like this video, and hit the notification bell to stay updated on our insightful discussions.